Is silver poised for $200 this year? Or is the market quietly setting a trap for those chasing headlines? Just weeks into 2026, silver explodes past historic highs. Then, in a single violent session, it collapses more than 30%. Investors rush in, then rush out. The dollar surges, confidence shifts, and billions move in silence. Is this the beginning of a historic breakout toward $200, or the early warning sign of a speculative overheating cycle? Because when precious metals move this aggressively, it's rarely about the metal alone. It's about power, policy, fear, and positioning. And what happens next could redefine portfolios across the business world. But the real question is not whether silver can reach $200. It's who will be left standing if it doesn't. Well, welcome to Boring Currency Index, where noise is ignored and signals are studied carefully. If someone has seen more than 5 decades of economic cycles, if they have watched markets rise and fall over the years, then they already know that clarity matters more than excitement. They are invited to subscribe, not for drama, but for disciplined insight. And they are invited to share something simple. From which city, from which country are they watching today? At the beginning of 2026, silver did not move quietly. It surged. Within weeks, the metal climbed above $121 per ounce, reaching a level few investors had expected so early in the year. Markets were barely settling into January when volatility began to dominate headlines. Prices rose rapidly. Confidence seemed strong. Capital flowed into silver with urgency. But the rise was not random. Global markets were already under pressure. Investors were watching economic signals carefully. Inflation concerns had not fully disappeared. Interest rate decisions were still uncertain. Many participants felt that financial stability was fragile. In such moments, they often turned toward hard assets. Silver became one of those destinations. For business leaders and entrepreneurs, this movement was not just about price, it was about psychology. When uncertainty increases, investors look for protection. Silver has long carried the image of a safe haven asset. It is tangible. It is limited in supply. It often attracts attention when trust in institutions weakens. As discussions intensified about who would replace Jerome Powell as Federal Reserve Chair, uncertainty grew. Markets disliked leadership ambiguity. During that period, silver prices continued climbing. Then came a turning point. On January 30th, silver experienced one of its sharpest single-day declines in decades. The drop exceeded 30%. The cause was not a mining disruption. It was not industrial demand. It was policy. President Trump announced Kevin Warsh as his pick for the next Federal Reserve Chairman. The announcement reduced speculation around Fed leadership. Investors interpreted the move as stabilizing for monetary policy. The U.S. dollar strengthened almost immediately, and silver fell. This reaction revealed an important truth. Silver was not only responding to supply and demand, it was responding to confidence. When trust in monetary leadership appeared fragile, silver gained strength. When stability seemed restored, investors rotated out of the metal. By early February, silver was trading near $88 per ounce. The correction was sharp. Yet, even after that dramatic fall, the iShares Silver Trust remained up more than 12% for the year, far outperforming the S&P 500, which had gained only around 2%. Such volatility sends a message. Silver in 2026 is not behaving like a slow, steady hedge. It is acting like a momentum-driven asset. Rapid gains attract attention. Attention attracts retail investors. Retail flows can amplify movements, but fast rallies often create fragile foundations. Entrepreneurs observing this pattern should focus less on the headlines and more on structure. When prices rise quickly, they invite speculation. When speculation builds, reversals can become violent. The January collapse was not simply a drop. It was a warning about positioning risk. Momentum can push assets higher than fundamentals justify. It can also reverse without notice. The question now is not whether silver can rise again. It is whether the recent surge reflects durable economic pressure or temporary fear amplified by policy uncertainty. Silver SE's early performance in 2026 shows one thing clearly. This market is being driven by confidence cycles. And confidence, once shaken, rarely moves in straight lines. Silver does not move on emotion alone. It moves when confidence shifts. In 2026, the real force behind silver's volatility is not the metal itself. It is the balance of trust between investors and the monetary system. When that balance tilts, capital responds quickly. The strengthening of the U.S. dollar after the Federal Reserve announcement revealed this relationship clearly. Historically, silver and the dollar often move in opposite directions. When the dollar rises, metals tend to weaken. When the dollar falls, metals gain strength. This inverse pattern is not coincidence. It reflects global capital flows. When the dollar strengthens, investors feel more secure holding cash or dollar-based assets. When confidence in monetary policy weakens, they search for alternatives. Silver becomes attractive in those moments. In early 2026, inflation debates remain unresolved. Some analysts argue that inflation pressures are cooling. Others warn that structural issues, energy costs, supply chain shifts, geopolitical tension, could reignite price increases. This uncertainty creates instability in decision-making. For business leaders, inflation is not theory. Strategic planning depends on predictable costs. When predictability disappears, defensive assets become appealing. Silver benefits from this mindset. But inflation alone does not explain the possibility of $200 silver. Institutional capital plays a different role than retail money. Large funds move slowly and strategically. They evaluate long-term macro conditions. Retail investors, however, often respond to momentum and headlines. The rise above $121 per ounce attracted attention across financial media. Social platforms amplified the narrative. Exchange-traded funds like the iShares Silver Trust made access easy. Accessibility increases speed. Unlike physical ownership, ETF exposure allows investors to enter and exit positions instantly. This liquidity can create rapid upward pressure. It can also trigger swift declines when sentiment changes. The January crash showed how quickly capital can reverse direction. Another factor adds complexity. Industrial demand. Silver is not only a store of value, it is used in electronics, solar panels, and advanced manufacturing. As global energy transitions accelerate, industrial demand for silver continues to grow. This creates a structural floor beneath prices. However, industrial demand moves gradually. Speculative demand moves suddenly. If silver were to approach $200, speculation would likely be the driving force, not mining shortages or production shifts alone. Entrepreneurs and investors must recognize the difference between structural demand and narrative-driven acceleration. Structural demand supports steady growth. Narratives create spikes. At present, silver stands between these two forces. On one side, there is genuine economic uncertainty. On the other, there is speculative enthusiasm fueled by early year gains. The key question becomes this: is capital flowing into silver as a hedge against systemic risk, or as a short-term trade seeking rapid returns? If the dollar weakens again, if inflation fears return, and if confidence in monetary stability declines, silver could regain upward momentum. But if economic signals stabilize and policy clarity increases, speculative flows may fade. The path to $200 would require sustained fear, prolonged uncertainty, and powerful retail participation. Without those elements, sharp rallies may struggle to hold. In 2026, silver is not simply a commodity, it is a reflection of institutional trust. And trust, once tested, rarely settles quickly. The idea of $200 silver does not begin with supply. It begins with belief. Throughout financial history, major price surges have rarely started from data alone. They begin when a narrative spreads faster than caution. When enough participants start asking the same question, what if it keeps going? Momentum becomes self-reinforcing. In 2026, silver stands at that psychological edge. After crossing historic highs above $121 per ounce, attention shifted quickly. Financial media amplified the move. Online communities discussed breakout targets. Retail investors, empowered by instant trading platforms, saw opportunity. The question was no longer whether silver had risen. The question became how far it could go. For silver to approach $200 within a single year, conditions would need to align aggressively. First, fear would need to intensify. Not mild uncertainty, but visible instability. A renewed inflation spike, geopolitical tension, or policy misstep could weaken confidence in traditional assets. In such an environment, capital often searches for hard stores of value. Second, the US dollar would likely need to weaken. A strong dollar suppresses commodity prices. A weakening dollar, however, acts as fuel. If global investors perceive monetary policy as overly loose or inconsistent, metals tend to attract renewed demand. But the third factor is the most powerful: retail momentum. Markets today are lightning fast. News goes viral, and a great story can rally millions of small investors in just a few days. Take silver, for example. Funds like the iShares Silver Trust let people pile in without ever touching a physical bar. This turns a wave of interest into real buying pressure. This collective power can trigger massive short squeezes, pushing prices way beyond what anyone thought was logical. It can make the impossible seem possible, at least for a moment. But there's a huge difference between hitting a price and staying there. History teaches us that when prices skyrocket, they almost always overshoot their true value. People FOMO in at the top. The moment things slow down, everyone rushes for the exit at once. Could silver hit $200? Maybe, in a perfect storm of hype and speculation. But would it last? That's the real question. Thanks for watching. Don't forget to subscribe for more insights. Sustained $200 silver would require more than excitement. It would demand prolonged economic instability, persistent inflationary pressure, and durable institutional accumulation, not just retail enthusiasm. Speculation can accelerate markets. It cannot permanently replace fundamentals. The danger lies in assuming that rapid appreciation equals long-term transformation. Momentum can create wealth for disciplined participants. It can also erase gains for those who enter without strategy. The $200 question, therefore, is not simply about price, it is about positioning. Because when belief becomes the primary driver of valuation, markets tend to reward the early and test the late. And in 2026, silver stands at that delicate boundary between structural demand and speculative ambition. By the time silver approaches historic territory, the most important decision is no longer about targets. It is about structure. Serious investors do not ask only, can it reach $200? They ask, what role should it play if it does not? Silver, especially through vehicles like the iShares Silver Trust, offers accessibility and liquidity. It allows exposure without storage costs. It can be bought and sold within seconds. For portfolio managers, that flexibility is useful. For retail investors, it lowers barriers. But liquidity increases both opportunity and risk. In 2026, silver has already demonstrated extreme price swings. A 30% drop in a single day is not a minor fluctuation. It is a structural reminder that commodities behave differently from productive businesses. Stocks represent companies generating revenue, expanding operations, and compounding earnings. Silver does not produce cash flow. Its value depends entirely on market demand and perception. This distinction matters. The Motley Fool Stock Advisor team recently identified what they believe are the 10 strongest long-term stock opportunities. The iShares Silver Trust was not included. That omission is not necessarily criticism. It reflects a broader investment philosophy. Long-term equity compounding often outperforms commodity cycles. Historical examples illustrate this clearly. When Netflix appeared on their list in 2004, a $1,000 investment grew into hundreds of thousands of dollars over time. Nvidia delivered similar extraordinary compounding. These gains did not rely on fear cycles. They relied on innovation, expansion, and sustained earnings growth. Silver operates under a different logic. It performs best during uncertainty. It rises when confidence weakens. It attracts attention when institutions are questioned. But once stability returns, enthusiasm often cools. Price cycles can reverse sharply. For entrepreneurs and business leaders, the lesson is discipline. Silver can serve as a hedge. It can diversify a portfolio. It may provide protection against systemic risk, but it should not replace productive assets. Position size must reflect volatility tolerance. Time horizon must match economic outlook. Emotional reactions must be removed from allocation decisions. If silver climbs again toward previous highs, excitement will increase. If headlines begin projecting $200 as inevitable, participation will expand. But disciplined investors will evaluate exposure carefully. They will consider opportunity cost. They will assess whether capital is better deployed in income-producing ventures or held defensively in metals. Prediction creates noise. Positioning creates stability. Silver may rise further in 2026. It may even test levels that appear unrealistic today. But it may also stall or retrace if policy clarity strengthens and inflation fears ease. The outcome is uncertain. What remains certain is this: capital flows toward clarity and away from confusion. When markets become unstable, defensive assets gain strength. When stability returns, growth assets recover dominance. The strategic decision, therefore, is not about guessing the exact price of silver. It is about preparing for both outcomes. Because in volatile environments, survival does not belong to those who predict correctly. It belongs to those who position intelligently.